Hey everyone, welcome back to Fiscal Beacon. Today, we are tackling one of the most intimidating topics for young adults, recent graduates, and anyone new to the financial system: how to build credit from absolutely zero. Let's start with a hard truth. In the United States, your credit score is often more powerful than your actual income. Think about it. You might make $100,000 a year, but if you have no credit history, a landlord might deny your apartment application. A bank might deny your car loan. You might even get charged higher rates for insurance. It's not about how much you earn, it's about how you've managed debt in the past. And if that past is empty, that's what we're fixing today. By the end of this video, you will understand exactly what a credit score is, the 3 best ways to build it from scratch, and the specific mistakes that can tank your progress before you even start. Let's dive in. First, let's demystify the beast. What is a credit score? Most of us are talking about the FICO score, which ranges from 300 to 850. Think of it as a report card for your financial behavior. But here's the kicker. You don't have a report card yet if you have no credit. You have a thin file. Lenders don't know if you're reliable or a risk, so they treat you like a risk. That's why getting that first credit account is so critical. Your score is made up of 5 main factors. We need to know these because they dictate your strategy. First is payment history, which accounts for 35% of your score. This is the big one. Did you pay on time? Second is amounts owed or credit utilization at 30%. This is how much of your available credit you're using. Third is length of credit history at 15%. Fourth is credit mix at 10%, and finally, new credit at 10%. Since you're starting from zero, length of credit history is a non-issue for now, and credit mix will come later. That means we are focusing heavily on payment history and utilization. And that leads us to our first strategy. Strategy number 1, the secured credit card. This is the gold standard for beginners. If you walk into a bank with no credit and ask for a regular credit card, you'll likely be rejected. But a secured credit card is different. Here's how it works. You give the bank a deposit, say $200. That deposit becomes your credit limit. You can spend up to $200. If you pay it off, you get your $200 back. If you don't, they keep it. The bank has zero risk, so they are willing to report your activity to the 3 major credit bureaus: Equifax, Experian, and TransUnion. Let's look at the math. Imagine you get a secured card with a $200 limit. You buy $20 worth of groceries every week. That's $80 a month. Your credit utilization is 40% $80 spent out of $200 limit. That's actually a bit high for optimal scoring, but for a beginner, it's acceptable if you pay it off in full every single month. The key is the pay in full part. Never carry a balance on a secured card. Interest rates on these cards can be over 25%. If you carry a balance, you're just paying the bank, not building your score. Pro tip: look for secured cards that report to all 3 bureaus and offer a path to graduating to an unsecured card. Many major banks now offer these. Set up autopay for the full balance. This ensures your 35% payment history factor stays perfect. After 6 to 12 months of perfect payments, you'll see a jump. We've seen clients move from no score to 650 plus in under a year just by doing this consistently. Now, what if you don't want to tie up cash in a deposit? Enter strategy number 2, the credit builder loan. These are offered by credit unions and some online banks like Self or Chime. The concept is reverse. Normally, you borrow money and pay it back. With a credit builder loan, the bank puts the loan amount, say $1,000, into a locked savings account. You can't touch that money. Instead, you make monthly payments of, let's say, $25. Those payments are reported to the credit bureaus as a successful loan payment. After 12 months, you've paid $300. The bank releases the $1,000 back to you, minus any small fees. You now have $1,000 in savings and a solid installment loan on your credit report. Why is this powerful? Because it helps your credit mix. Lenders like to see that you can handle both revolving credit, like credit cards, and installment credit, like loans. Adding a credit builder loan diversifies your profile. It's a forced savings plan that simultaneously builds your credit. It's a win-win. Just ensure the lender reports to all 3 bureaus. Some smaller lenders only report to 1 or 2, which leaves gaps in your history. Strategy number 3, become an authorized user. This is a shortcut, but it comes with a caveat. Do you have a parent or a trusted family member with a long history of good credit? You can ask them to add you as an authorized user on their credit card. You get a card with your name on it, but you are not legally responsible for the debt. However, the account's history is added to your credit report. If your parent has a card open for 20 years with a $10,000 limit and a $0 balance, that history can boost your score significantly. It adds age to your credit history and lowers your overall utilization. But here is the warning. If they miss a payment or max out the card, it hurts you. You are trusting their financial discipline with your future. Only do this with someone you trust implicitly, and make sure the issuer reports authorized user activity to the bureaus. Not all do. Now let's talk about the traps. These are the mistakes that keep people stuck. Trap number 1, applying for too many cards at once. Every time you apply, a hard inquiry hits your report. This can drop your score by a few points temporarily. If you apply for 5 cards in a month, you look desperate for credit. Space them out. Wait 6 months between applications when you're starting out. Trap number 2, closing your oldest card. Once you build credit, you might feel tempted to close that first secured card or authorized user card. Don't. The length of your history matters. Keep that first account open, even if you don't use it often. Just put a small subscription on it and pay it off. It stays active and ages. Trap number 3, ignoring errors. Once your credit is built, check it. Go to annualcreditreport.com. It's free. Look for accounts you didn't open or late payments that were actually on time. Dispute them. Errors happen, and fixing them can give you a quick score boost. So, what's the plan? Here is your action checklist. First, open a secured credit card with a low deposit. Second, use it for small, regular purchases and pay it off in full every month. Third, consider a credit builder loan to diversify your mix. Fourth, check your credit report in 6 months. Track the progress. Remember, building credit is a marathon, not a sprint. It takes time, but the payoff is massive. A good credit score can save you tens of thousands of dollars over the life of a mortgage or car loan. For example, a difference of 100 points on a 30-year mortgage can save you over $40,000 in interest. That's not just a number on a screen, that's freedom. This information is for educational purposes only. I am not a financial advisor. Consider consulting a financial advisor for personalized advice tailored to your specific situation. Everyone's financial landscape is different, and what works for one person might not work for another. If you found this guide helpful, hit that like button. It really helps the channel. And subscribe to Fiscal Beacon for more no-nonsense money advice. In our next video,